Federal Reserve comes into focus again this week with a meeting in Washington tomorrow. After last week's monthly jobs report showed companies hired fewer workers than many had forecast, will Ben Bernanke be pushed to inject more stimulus into the economy? Jim O'Sullivan is the global chief economist for MF Global, and he says there's no reason to worry about a double dip at this point. I know you were saying here, Jim, that you weren't expecting another round of stimulus, but did Friday's jobs figures change your perspective?
Well, they weren't all that surprising relative to what we were looking for. Certainly there were revisions which made the numbers a little bit weaker. In the end, we still think that the trend in growth will be strong enough and the trend in inflation positive enough to obviate the need for any significant further stimulus from the Fed. I mean, that said, inflation is already low enough, and the numbers have clearly lost some momentum, including Friday's report, such that I think there is pressure on Fed officials to at least highlight downside risks, signal a bias toward easing, and perhaps, as suggested by the Wall Street Journal last week, maybe even make a token move in the form of reinvesting proceeds from maturing mortgage-backed securities.
Well, can we expect language to that effect tomorrow? I mean, you don't consider that significant stimulus to be purchasing.
In the end, there's about 130 room under the original 1.25 trillion that they bought on MBS to top up if they want. Now, given the given the 2 trillion plus size of the Fed's balance sheet, that's not a huge number. I mean, if the Fed has to come back and do significant further stimulus, it won't be for $100 billion. So it would be a relatively small move, and I don't think they're ready at this point to make the big move of, say, coming back and buying $1 trillion more of treasuries. Again, I think in the end the trend in growth will be strong enough to obviate the need for that. But at this point they do have to show some concern. The momentum in the numbers has been down again. Remains to be seen how far this momentum goes.
You know, Friday's jobs figure, even for those who had a more sort of conservative or pessimistic view as to growth in the second half of the year, we did see Goldman Sachs bring down their growth estimates. You did hear from other houses sort of more language indicating caution. Why is it that you think that we are still going to see growth among the lines you had already projected?
Well, I mean, first, the employment report itself was not that weak. Private payrolls were up 71,000. If you look at the first half of the year, you're up 93,000.
Either.
No, but you look at the past year and you've had 3.2% GDP growth with 0 hours worked. And the hours worked number on Friday started the third quarter up at a 1.8% annual rate. Now, it's still true that you're not getting enough strength in the labor market to make this a satisfactory recovery. But you combine the hours numbers in the employment report with the ISM data that came out last week, and you're still getting growth. I mean, this is not a double dip. Now, it's up for debate what happens next. And I think there's an argument that can be made that markets probably overreacted to the turmoil in European bond markets a couple of months ago. And at this point, the effects of that are starting to fade. I think that was a key driver of the loss of momentum in a lot of the numbers recently. And give it time, that loss of momentum will fade again. But that said, I mean, the numbers are still disappointing, absolutely.
Now, the counter to the optimists out there besides jobs is what's happening in housing. Just this morning, you know, Freddie Mac says that FHFA is going to submit a request for nearly $2 billion in funding. Last week we heard from Fannie they want $1.5 billion. Yeah. How does that not underscore real weakness in housing and concern about mortgages?
Well, in truth, housing has not really been a big contributor to the recovery. I mean, you look at the 3.2% increase in GDP in the first year of the recovery, and housing's contribution has been pretty minimal. Of course, Fannie Mae and Freddie Mac have already taken almost $200 billion from the government, so a couple more $1 billion is not that big a deal in that context. The housing numbers have been very volatile because of the tax credit. Obviously, the latest move has been down because of payback for the tax credit. But in the end, you step back and the trend in sales doesn't look all that different over the past year. Home prices seem to have bottomed a year ago. But it comes back to the labor market and consumer spending. That's really the key.